Welcome back. Well, the U.S. Central Bank, the Federal Reserve, or the Fed, extended its fights against high inflation on Wednesday, raising its key interest rate by a quarter point or 25 basis points, its eighth hike since March. Although it was smaller than its previous hikes and even larger rate increases before that, the Fed's latest move will likely further raise the cost of many consumer and business loans. Although the Fed kept language in its statement suggesting that more rate hikes could be in store, it did note for the first time that price pressures are cooling. The Fed noted that inflation has eased somewhat but remains elevated. Even though the Fed signaled that inflation is easing, it remains high enough to require potentially further rate hikes.
He raised the target range for the federal funds rate by 25 basis points, bringing the target range to 4.5 to 4.75%. And we are continuing the process of significantly reducing the size of our balance sheet. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over.
And to discuss further about the Fed's latest rate hike and its impact, I'm joined by Teguh Wicaksono, the head of Mandiri Institute. Good afternoon. Thanks so much for joining us.
Good afternoon. Thank you for inviting me.
Right. So first, I want to get your reaction to the Fed's 25 basis point rate hike, much less aggressive than their previous rate hikes, but in line with market expectations. Do you see this lower rate hike as a relief to the U.S. and global markets?
So, well, I think the Fed decision appears to be sort of acknowledgement that, this inflation has begun earlier and growth is slowing. And I think it might be a relief to emerging market. But if we heard very closely the Fed statement, the fact that Chair Collins, they will deliver a couple more interest rate increases before putting their aggressive tightening campaign on hold. So I think in the next few months, we should anticipate that the rate hike continue, but probably at a lower rate.
So, throughout the year, do you see maybe 25 basis point rate hikes in the months this year from the Fed?
Yes, we anticipate that, for instance, like probably they will, in the March meeting, they will increase again. If given that, the trend of inflation and we expect that this inflation will continue, so we might anticipate that 25 basis point on March, and then they will keep constant by April, and by June they will raise again up to 5.25. So basically, like by June, forecasts say that that's the peak of the Fed rate. After that, the Fed starts to cut the rate.
Okay, so June potentially could be the last rate hike by the Fed. So first, let's talk about the impact to the U.S. and the impact of the latest rate hike to the U.S. stock and bond markets in the short term. What are your views?
So, well, as you mentioned earlier, that the stock markets, kept up by 1%. So I think in the U.S., particularly financial markets, investors appear to be optimistic. So they took heart from the chair's remark, acknowledging that the price pressures have started to ease, even though actually the chair give a signal that they will continue to increase the rate. So the way I see here, I think there seems to be different perception between markets and Chair Powell. So Chair Powell sees inflation moderating without plummeting. So still the rates will stay high. But on the other hand, markets see inflation dropping like rock, so pushing the Fed to cut. So I think in a way it's a good thing, but one thing is like, it might, this different in perception might be, worrying because, the market expect that the Fed will cut. Instead, the Chair Powell will increase the rate.
So basically the markets are having this view that inflation, the concerns are receding, things are going to be okay. The Fed maybe not really wanting to say that, just said But what is your view, though? Do you see, because US inflation in the U.S. is easing. It's been easing since last June or July, if I'm not wrong, when it hit a high of 9.1%, continuously eased in the months after that. Do you see U.S. inflation continuing to ease this year?
Yeah, I think so because like we might anticipate that the commodity prices will experience a correction. Energy, energy prices will return to the normal. But again, if we if we hear closely what Chair Powell said that this inflation process is on the early stage, and he said that interest rates are not yet at a sufficiently restrictive level. So he anticipates that the inflation remain risk. And also, if we look at the last inflation rate is 6.25, right? So 6.5, which is far higher than the target, the Fed's target. So I think that's a clear indication what the Fed will do in the next couple months.
Right. So you still see inflation as a concern in the U.S. Of course, many food prices are still high, eggs being one of them. But let's turn back to Indonesia and look at the impact of the latest 25 basis rate hike by the Fed on Indonesia. How do you see it affecting specifically the Indonesian rupiah and also the stock and the bond market here in Indonesia?
Yeah, I think it's very interesting when we talk about this Indonesia capital market. So, we see that we see capital inflows to emerging market, including Indonesia. But if we look at carefully, I mean, like bond market, I think experience really good capital inflow. So that's why the reason why we see appreciation of rupiah these days. And also investors also expect that inflation rate in Indonesia will subside. Central bank really take control of volatile prices. But when we talk about stocks, I think it has different stories. I mean, like with the story about this China reopening, so the global investors started to rebalancing their portfolio across different countries. So they allocate their investment from Southeast Asia, including Indonesia, to China because they expect China's reopening policy will boost the demand by the probably second semester once China experience like what we call as maintain the COVID-19 early, very good.
Right. And talking about capital inflow and outflow, specifically in the bond market, with the U.S. Federal Reserve potentially slowing its rate hikes this year, do you see maybe more capital inflow to the emerging markets like Indonesia?
Yes, I think so. But capital inflows will go mostly to the bond market. So I think the story probably in the first semester of this year will be the nice story about bond markets. For stock markets, probably it's a little bit different, and probably we will see in the second semester this year that stock market experience good story because the capital inflows will start to stock market in Indonesia because with China reopening and China normalization, then external demand from China will increase and it might affect positively to Indonesia's companies.
How about the effect of the Indonesian rupiah with the Fed with a much less aggressive 25 basis point rate hike just last night, and also potentially less aggressive rate hikes throughout the year? Do you see the rupiah improving further, at least in the short term?
Yes, I think so. Because with this good news, from the rate hike and from the Fed rate, and then China will reopen, and then the economy will boost. So I think, that is good news particularly in the second semester of this year.
Okay, all right. We're going to take a very short break, but we're going to continue our discussion more specifically about the U.S. economy and the global economy. Will we still potentially see a recession this year?